Welcome to market structure. So many people have the wrong idea when it comes to growth, structure, discipline, confidence, self respect. And they think you need the most craziest schedules, you need the most craziest things to do just to grow 1% a day. And that's what make market structure hard for people in trading. Looking for everything outside of you just been a problem. Looking outside of everything besides you, just having clarity. Market structure is a 3D perspective. People come into trading and they think you can just buy and sell. And that is the problem, because some people don't even think you can sell. Some people just think you can buy. In trading, the market does two things. It goes up and it goes down. Let me ask you something. How many sides does a coin have? You probably said two, heads and tails. And we'll leave that for the next video. But the market goes up, down, and sideways, right? So knowing that the market does those three things, that gives us the opportunity to understand that the market doesn't just go up and down. The market is not 2D. More than one thing can happen. It's like 70. It's like Avatar, Fortnite, Call of Duty, right? It's not like Subway Surfers, Pac-Man, and shit like that. You see what I'm saying? So, market structure to me, man, is simply being able to say the person who can admit that they're wrong the fastest is the smartest. Market structure is number one. Market structure is the only indication that you need technically to print and make money in trading. You don't need anything besides market structure to understand what's going on charts. And the problem is, everybody wants to be perfect in trading, but you can't be perfect. The market structure is going to tell you how clear the picture is. And all you doing is painting the perfect picture to get you to what your aim is. So when we start at having bias and shit like that, it's not about having a bias. It's about once you enter, you have a bias. It's not about prediction. It's not about, indicator. People bring so many indicators because they want to be perfect. Because those people are smart. Because they understand numbers. They understand this and that and that and that. All of this shit that's all perfect systems in a market that's just greed and fear. Market structure is all that you need to understand trading. You need more than just market structure to enter trading and make money. But to understand trading, to be able to explain it, market structure is all you need. To be able to see where the market is going, most likely, where it's showing that it's going, definitely, is market structure. So, don't complicate it. Keep it fixed. Never correct it. When it's fixed, it's something that's never going to change. When it's corrected, it's more of a variable. That's it, y'all. Let's get on the templates. So boom, welcome to market structure. When it comes to market structure, it matters more of where you are than what you think. See, so many people come into market structure and they think, well, hey, it has to be the same every single day. They think, well, every day is going to be the exact same at the exact same time, in the exact same way, and that is what makes trading dangerous for some people, because some people look at trading the wrong way. See, they see the market only goes up and down, right? But the market goes more than just up and down. It goes sideways. When the market goes sideways, that goes right back into the whole point, the whole idea, the whole perspective of, boom, the market go down, boom, up, boom. And the thing is, a down market just means that floors are getting broken. An up market means that ceilings are getting broken. But when we came right here, this didn't get broken, boom, that got broken, boom, but it didn't get broken again, boom. And now we see, well, damn, in this whole area right here, we just in some type of range, bro. We ain't getting nowhere. And then we finally broke above it here. Now we see, okay, let me go up, boom. And now we see ceilings are getting broken and those ceilings are becoming floors. The cycle is, at the top of an uptrend, we have range again. Just like at the bottom of the downtrend, we have range. So boom, now we see the same thing happening for a downtrend. We need floors to get broken, right? Boom, boom, boom. And we see at this point, we wasn't really getting above or below. So at this point, we'll either consolidate again to go up or continue going down. And that's the importance of trading and understanding market structure. Doing it this way, it's fixed, but it does come with some discretion because you have to really know what you're talking about to be able to read structure. But having a type of strategy that can cut down your decision making, and you can just see, okay, if this is a high, this is low, and this get broken, boom, 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 boom. Every single candle is a whole new ceiling. It's a whole new lifetime, whole new lifespan, right? It's 4 different markets: trending market, choppy market, low volatility, high volatility. A high volatile market is a type of market that's just dangerous, crazy, crashing waves. A low volatile market are just less dangerous, crashing, crazy waves. A trending market is a market that is smooth waves and it's just moving. It's like gold, like it's just gonna always move. It's gonna always move. But a choppy market. Monica asked me about a choppy market, and it's so funny. Like, she said, do you think I should trade in a choppy market? I said, yeah, because having a choppy market happens. It could be times when you trade and, hey, 30% of the year was choppy, right? You could skip over those years, but some people might want to trade every month, right? Not understanding that most of the time you're going to make most of your profits within that bunch of a year. And now you're in the defensive mode and just do it all over again. Or just do what you did at first, right? Like, 1 million in 100 days. Okay, well, damn, let me take 500 now and make 5 million in 500 days. Why most traders lose. See this right here? They only see up and down. They think trading is 2D. Up and down is like Pac-Man, that's it. But trading is 3D. But understanding that the market goes up, down, sideways, right? That sideways action is us being able to trap noise, shame, apathy, guilt, whatever, all these different people that's telling you in your ear, oh, stop doing this, whatever, because trading comes with a lot. But see, chasing that certainty that you just don't lose is what hurts the most. They ignore risk. Risk goes like this. What's the worst that can happen is what happens after the worst that can happen. That's what risk is. Risk is everything that could possibly go wrong because life is full of surprises. 99% surprises. So look at trading the same way. It's 99% surprises. You can have the most perfect setup and still be wrong. And that's the problem. It's like, when you look at it, the second thing that can happen worse after risk is popping your account. Well, popping your account isn't worse than risk because risk could mess with your psychology, your cycle, how you feel psychologically, right? How you feel mentally, your decision making. It can affect you saying, let me strategy hop. It can affect you saying, well, damn, I don't care to hold this trade. I don't care how many bullets in this trade. I'm just gonna fire. So you have what's the worst that can happen, which is you lose your psych. Number 2 is what's the worst that can happen, popping your account. Number 3 is, can I hold this trade overnight? Is it so perfect of a trade that I can step away from it and then pay me in my sleep? And then number 4, it goes to, what is it? Well, how many bullets do I have? In a live account, I might have 100 bullets. In a prop account, ignore risk. So the worst that can happen is life is full of 99% surprises. Popping your account, how many bullets, being able to hold this trade overnight, and how many bullets you have. Some people might get so sniperish, all you need is half a bullet. Because, we ain't even gonna know that. We gonna show it. They change their strategies monthly. Most people so focused on win rates, right? You got a 40% win rate, and you need a certain amount of bullets. I mean, you can lose 60% of the time. But what if that's 60% in a row? Losses are random. Wins are random. It could be the most perfect equation, the most picture perfect. You see the image, this shit like beautiful markup, and that bitch make you say, nah, I ain't gonna, nope, I'm gonna get in, and that bitch eat you, right? That's the whole point of a win rate. You got an 80% win rate, and I mean, you lose 20% of the time. But now it's how many bullets? As in, how many, like, if you're risking 1%, then you might have 100 bullets. If you're risking 20%, you got 5 bullets. You're risking 25%, 4 bullets, right? Right? And now it's, how many trades am I taking a day? If I'm only gonna risk 1%, and I'm taking 10 trades, then that means, damn, every single trade gotta be 0.1. So it goes into saying, well, if I have this many bullets, well, what's my sample size? Is it 1,000? Is it 100? Is it 500? Because if it's 1,000, that's 20% of 1,000 is 200. That means that you're losing 200 times. But is it 50 times, 10 times, 30, 50? What is it? 200 times in a row. Because having a real system, a good system, a well system, it's a 1 in 300 chance that you're going to lose 3 times in a row. Losing 10 times in a row, it's impossible. You can't count a system if you don't do the exact same thing every single trade. You buy the same way you sell, and you sell the same way you buy. See what I'm saying? So then we're going to say, well, dang, if I keep changing strategies, how will I ever really be able to know if something worked? Because if you're doing reps of 10, that ain't much. 20, okay. At least 50, 25, at least a month. A month, so 20, at least a month. I'm doing the exact same thing. Because so many people come into trading and now they want to add their emotions because they lost. But they lost because they didn't follow their system, they followed their emotions. You don't want to follow your emotions. You want to follow a system. You didn't earn to be able to say, oh, that was because it's my psychology that you lost. You shouldn't be there yet as a new trader. The market isn't random. Your entries are. You're not doing the same thing every single time. Jeez. The wrong question. Should I buy? Should I sell? And go back into 2D thinking, forgetting where am I in the market? Am I trending? Am I chopping? Is it volatile? Is it low volatile? Before asking where you are, you gotta ask where you are. Where am I? Where am I? Where am I? Am I in an uptrend, downtrend, sideways trend? Is it volatile? Is it trending? Is it just choppy for the next 5 minutes, or is it choppy for the next 5 hours? Right? Because once you understand where you're at, now you know how to play it. The daily market can be choppy, but we can still hit a 20x on the 1 minute, 5 minute charts. The daily markets, hour markets, 4 hour markets can be choppy, and we still can hit a 20x on the 1 minute, 5 minute charts. A 1x is 100%. A 5x, 500, 10x, 20x, 2,000%. We can hit 2,000% profit in the market that could be chopping on a daily and 1 hour charts. But it's always about where. It's where. The right question is, where am I in the cycle? The 4 market positions: uptrend, range at the top, downtrend, range at the bottom. Range at the bottom, it feels like quicksand. It's like quicksand. Imagine trying to get out, and the more you try to pull out, you try to put your hand in the quicksand and get out, now your hand and your arm stuck. You try to put the other one, now that one's stuck. That's what range at the bottom feels like. Floors stop being broken, which is just basic market structure, and then long wicks appear at the bottom of candles, right? Super long wicks. Like if the wick is longer in the body, but you like seem to be like at the bottom of a trend here, these are all wicks, wicks, wicks. So it feels like, boom, it's like, let's make some type of sand here. And then boom, we just crash fast, and boom, we can't really go below this. Range at the top. It feels like you enter space, the ceiling stop being broken, right? You can't get above this now. Long wicks start appearing at the bottom of the candles, or at the top of the candles, right? Boom, it's like, it feels like you enter space, where it goes up, now you just like, boom. You can't get above this level. And you once was able to, right? High, broken, boom, boom, right? So how greedy are you? Most people think trading only means buying like an investor. Investors care if the company makes money or over years. As traders, we care about movement. We can make money when the market is going up or when the market is going down. We are not married to direction. We follow expansion. Most beginners think sideways markets are born. The sideways is actually where the trends are created. Sideways markets are like a cooling pot. When pressure is building inside, buyers and sellers are fighting for control. Neither side has fully won yet. Then eventually, price breaks above the range or below the range and closes outside of the boundary. That's when expansion begins. We call this a slippery slope. One side loses control and the other side takes over. The further price moves away from the range, the stronger the expansion can become. This is why traders study consolidation, ranges, and accumulation, because trends are born from sideways action. The goal is not predicting, the goal is waiting for confirmation, then reacting with structure. This is the market cycle. Like, let's draw it up and we say, okay, consolidation. Consolidation is when we are really going up and down in the same area over like hours, like a long periodic time. Range, that can just mean this is the furthest that price went in 10 seconds, 30 seconds, an hour, 30 days, 50 years. And then you can say accumulation. Accumulation is sideways action, but it's like we're not really standing inside of it, but we're not really breaking away from it. And that's the difference of a break and a breakout. So it's always about protection and foundation. Your ceiling is your protection. You have a ceiling on the top of your house to protect rain from getting inside. That's why you wouldn't want to have a roof and then have holes inside your roof, right? So when you break and you trying to climb through the roof, maybe you got like a flood or something crazy, right? You would now be standing on your ceiling, on your roof. And now your roof is a floor. And that lets you know that the market is going up if ceilings are getting broken. Then you have foundation. Foundation in the house is because you don't want to get in bed with mud on your feet. Or you simply know, okay, well, hey, what do that mean? Every protection, every ceiling, every roof needs a foundation. So if you don't have a foundation, then you don't have a roof. So when you look at saying, if I was to dig through the basement, under the basement, well, now you'll be below the floor. And now what's above you? Your ceiling. So these can actually move right here. And when it comes to the moving, ungroup it, boom, right? We breaking, but until this candle stopped moving and another candle opened up, it did not close. The ceiling did not get broken. Candles can come all the way up here and snap right back down and close under, which means the ceiling did what it's supposed to do. Same thing for a floor. We could be up, down, come all the way down here and then snap and close under. That means that the ceiling is still a ceiling and the floor is still a floor. What market structure is? Market structure is when a trend starts forming. Pivots show you if the trend really is going up, down, or sideways, aka range, accumulation, consolidation. They are the outskirts of the market. Depending on direction of the market, highs and lows, equal highs and lows are created. Sideways action happen at the top of the uptrend or at the bottom of a downtrend on every single time frame. Second time frame, yearly time frame, it's omnipresent, meaning that it's always there in every market, in every condition. It's just how long am I in this condition and how long am I going to stay in this condition. Condition means uptrend, downtrend, sideways. That sideways can be highly volatile, low volatile. And then you have choppy and trending markets. Trending is the up and down. An uptrend. So many people like to trade on the computer because it shows them more, because they want to be able to predict. But the true definition of being a trader is being able to own your time, being able to have freedom, being able to, in a sense, not be bound to like a desktop, right? So being able to trade on your phone does two things. When you're trading vertical, your phone is vertical like this. It limits you looking so far in the past, because you can look and see, dang, the market been going down this whole time. But only thing that matters is what happens from the time you get to the market. So you only need one higher low, which is one foundation, and two ceilings. You can have two ceilings just off one foundation. Couldn't you have a duplex in one house? Couldn't you have a threeplex in one house? A multi-family in one space, one foundation, but now you got 50 ceilings. If it's a layer, if it's more than one floor, that's a ceiling. So start with a low, we come down, boom. And I think in trading this against every single psychology. An uptrend starts low. When it starts low, it makes a high. We know it's a higher high because that higher high is higher than our previous. We come down, HL, higher low. It's a higher low because this low is higher than our previous low, which also means this foundation is now, this ceiling is now the foundation, it's now a floor. Boom, we break above, now this high is going right back into, well, dang, we broke above the previous high. We're not supposed to break through ceilings. But now we bounce off the new ceiling, now we come down to the old ceiling, that becomes a floor. Old ceiling floor, old ceiling floor, old ceiling floor. But you only need one high, one low, one higher high to know that you're in an uptrend. All you need is one high, one low, one higher high to know you're in an uptrend. You don't need 50, because now you're waiting for the perfect time. Everything could be perfect and you can still lose anyway. So it's cool to have the perfect criteria, but having the perfect conditions, like I only need it to trade on, I only need high volatility, is stupid. You need to be able to trade in all markets and be able to trade in any condition, any weather, any storm. So, boom, when we go to the next one, we see, okay, uptrend replay. When you look at an uptrend, it reminds you more of a staircase. And you will see, dang, ceilings are constantly being broken. Old ceilings that couldn't be broken are getting broken now. Old floors in a downtrend that couldn't be broken, get broken now. Boom, boom, boom. Right, so we create this low, we go up, up, up. We create the high. So now, in the uptrend, we need one low, two highs. That means, since we had that low, we already got a low, and we have a high. If this high get broken, that let us know we in the uptrend. And we can't even say, dang, on a 1 minute chart, that's a 1 minute higher low, because it pulled back. It didn't retest, but it did pull back. Now we see, boom, ceiling got broken. We came back to the ceiling, right? Now we can't get above the ceiling. Boom. Now we just kind of chopping, not really going nowhere, right? Now we above the old ceiling we couldn't break above. And now the old ceiling is a floor. And now we're going to break above the new ceiling, and that new ceiling will be a floor too. And now all of these levels are red. They are floors. A downtrend needs one lower high and two lower lows. It goes right back into the market, right? When we in the sell, we in the sell from 3 to 7 days. When we in the buy, it could potentially be millennium. So since the market is designed, created to go up for long term, that's why investors have something called passive income. But when the market decides to go down and it's failed highs, failed high, failed high, a failed high means that we failed to go up. We failed to break the ceiling. And overall, most people need ceilings to be broken. But remember, we don't care if the market is going up or down. We just need it to move. So we know, okay, we started a low, we make a high. From this high, we made a lower low. From this lower low, we came up and made a lower high. It's kind of equal, right? It's like a zone. Boom. And now we make it even lower low. And now it's like we can't get above that ceiling, and we can't get above this ceiling, and we can't get above this ceiling, and we just keep falling down, right? But all we need is one low, one high, one lower low to know that we're in the downtrend. And this trade right here, this is that 10x trade we was talking about. Let's count it. 10x simply mean we're going to take a box over here. We're going to draw the same size box. All the way down to this. All the way down to just a leg it did. We ain't even going to do this leg and this leg. 2, 3, 4, 5. That's a 5x trade depending on how you play it. Meaning, you just hit 5 birds with one stone. Downtrend, replay, right? And remember, catching a downtrend is like a falling knife. That's why 3 days to 7 days we out of there. An uptrend is like bulls running up a hill. It's like steps. It's harder to climb and it's really easy to fall. It's easy to be on offense. It's really hard to be on defense. Boom, we made a low, we made a high. It's even quicker. Everything happened fast. We made an equal high. That would have been a perfect entry. And boom, we just shredded. Falling knife. It's like, first thing happened is the bears jump out the window with a honeypot. And then the bears take the elevator down. When it comes to an uptrend, the bulls run up the hill, blindfolded through a maze. And then, sheesh, I don't know what they do. They just take the rocket up. Like, they pretty much take the rocket up first. And then they just start climbing up the staircase. Bears don't jump out of windows because they don't live in houses. And bulls don't run up hills. They have zero navigation skills. They can only go straight. They can't goddamn sideways. When it comes to the sideways trend, sideways, this goes back to accumulation, range, and accumulation, range, and consolidation. Consolidation means this is a little different. This right here, this is from an hour chart. This is like 1 hour, 2 hour, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. That's 14 hours of going nowhere, right? But now, that's consolidation. That's over a period of time. And it can even be like the hour chart, like the 1 minute, 5 minute, but it's more like, I'm not going, don't quote me on it, but at least like 5 minutes of it really staying in that same area, right? And then we have range. Range means this is the highest that the candle went in that period of time, and that's the lowest it went. This could be the 1 minute, 5 minute, 1 hour. It could be the daily. It doesn't matter what it is. This is the highest and lowest it went in this period of time. That's what range is. And then let's talk about accumulation. The shark waters. Accumulation is when we can't seem to really break away from this area. We can break out of it. We can break it, but we can't break away from it. And then you kind of got like these smaller waves just inside of it. That's really what it look like. It's like, and if we was to make it clear, like a real market, it'd be like this. It'd be like, boom, we break above, now we come back. Break above, now we come back. Break below, now we come back. Break above, and then we chop. Boom, like, so how we retest it. In a choppy market, and you in a choppy market 3 weeks a month, and you just need to trade, that might be your stream of income only. Buy low, sell high, buy low, sell high, buy low, sell high, buy low, sell high, buy low. Sideways market, right? So we don't know. We assume we trending. So we assume, okay, it started high, so we must be in a downtrend, right? But we made this high, we made this low. And remember, once you understand market structure, you become the indicator. Boom, we broke above this high, so now this high is now a low, it's a floor, which means now that's our floor, that's our foundation. For an uptrend, all we need is 1 high, 1 foundation, 2 higher highs. Oh yeah, we entered. Simple. We got in. We thinking we about to print. We think we had something smooth, something fast. We down 4K already. Failed equal failed high, right? Simple, equal failed low. It should be low, but simple. We broke above this high. We came back down. We didn't break above this low, below the low. We broke back above the high. We tested it. Boom, and now we broke above the low. It's like, dang, you all over the place for real, right? When it's hard to read and paint the perfect picture, it might not be time for you to try to paint a picture. Just walk away. Common mistakes. Buying at the top of range, trying to paint the perfect picture, but you can't. Selling at the bottom of range, which is opposite, buy low, sell high. You selling at the bottom. If you're looking for continuations when you should be looking to just see what the market is going to trend. Trading inside of boxes, which is consolidation, range, accumulation. Switching bias every single candle, simply because you can't stomach the tug of war of greed and fear, buyers and consumers and producers, buyers and sellers. People consume out of greed and people produce out of fear. Sharon Kanashi. CBE rule number 1. If I don't know where the price is in the cycle, I don't trade. Only take no-brainers. Like, when you get in this trade, it should feel like, no duh I got in this trade. It's like, why wouldn't I get in this trade? Notes needed. Range, sideways, accumulation, indecision happens at the bottom of a trend and at the top of a trend. Market only goes up, down, and sideways on any time frame. We don't trade sideways action, we leverage it. We can make money as a buyer or a seller. Let's interview like this. The last two on. So much on. Alright. So boom. Alright, so boom. Let's get to the charts. Let's go deep, well deep. Pick one market, because this system works in all markets. It's omnipresent. Let's be specific. Crypto, options, stocks, futures. That's just about it. Forex. Mark up the first 1 minute high, and then mark up the first 5 minute high and low. See if floors fall continuously, or if sellers rise. Watch 20 to 30 minutes. Do it daily for 20 days. No trading required. All you need to do is just watch. You might be at that point where you started trading 2 weeks into your journey. Cool. All you got to do is come to the charts after you trade it. Before you trade it, just watch. You have to pay your ignorance tax. You got to get days of watching without just entering. And at the end of the day, most people admit it. I will also. Not too far, but like, I wish I did that. I wish I had times to just come into the market and just watching, but I had a different yield. My yield was I made $6 my first trade in 2 minutes. Shit, before that, I was in college. So, like, you get what I'm saying? Came from college. I was working at Denny's. I was making $13 an hour, bro. 16, 13, one of those an hour, bro. You don't know until it's born. You want to understand something so well that it excites you to learn more about it. A true master is the master of the basics. That's why I have people that might have learned from me that's been trading for 10 plus years. I'm 22 years old. Simply because I don't lack discernment. When you losing in a system that is really a system, meaning you're doing the exact same buy, the same way you sell, and you sell the same way you buy, you, it's going to change your whole perspective. It's going to open up your eyes to being able to just watch and realize, dang, 99% of trading is waiting. When you really understand that trading is the exchange, and everything that led up to that was speculation, exchange, fair value exchange. You only clicking a button to enter a trade in 10 seconds. You clicking a button to exit the trade in 10 seconds. You limiting so much of your decisions. It's like, let's head to the charts. Let's go on gold, XAU, USD. Boom. We said the directions was going to the 1 minute charts, and we want to just find the very first 1 minute candle. We don't even have to, it don't even have to be specific. It's going to just be the first 1 minute candle. Just find a candle, right? Because navigating, some people might have never been right before. So navigating is hard, right? This right here goes left, this goes right, and that's in the TraderView video, so I drop it faster. But boom, we're going to mark up this 1 minute high, and we're going to mark up this 1 minute low. That's it. We want to see if we're going to break above this 1 minute high, or we're going to break above the 1 minute low. Break below the 1 minute low, right? Boom. Boom, boom. This reminds me of my old double O striker strategy. I have so many different strategies, but inside of strategy, so many different strategies, but all those strategies are in one system. The same method, just a different way, maybe faster, maybe slower. We're not really looking to trade, but this one I used to take only 2x's, right? So I'm just gonna take it out to a 2x, because that's pretty much what this could represent. Take this down up to a 2x. Boom. All right, cool. So now, even though the candle didn't close, we're just gonna mark it up, and I'm gonna delete this. Or actually, I ain't gonna delete it, I'm gonna move it over, out the way. All right, so we just look at this 1 minute high, that's the same thing, 1 minute high, right? And this right here, this 1 minute high is a high, but that's a high that's now a floor, right? Which means that we might be going up right now. But we need this candle to close in the next 1 minute, 1 second, boom, there it goes. So now that's a floor. And now we want to be able to get above this one, since we're in the uptrend. If we're truly in the uptrend, right? And we know, all we need is what? This a low, this a high. Yo, this a high. We come back down. We got a higher low, because that's the bottom of that candle right here, right? And then we pretty much had an equal high. Then we come back down, we got a higher low, and now we even got another higher high. So from how we know, we're really in an uptrend right now on the 1 minute chart. And we don't never gotta take the 1 minute chart serious in the sense of holding trades. But you can definitely take the 1 minute chart serious in the sense of looking at basic market structure and just seeing how it's going up, how it's going down, or ceiling's being broken, or our floor's being broken. Which means right now, we're looking for, like, if I put a box here, this will show the whole entire noise. The whole entire noise, right? So that's the noise. That's pretty much anything inside of that. It's bullshit. We don't care what's happening inside of that. We want to know what's happening outside of it. And it goes right back into, dang, we just had this crazy drop off. But somehow we recovered and we still in the downtrend or the uptrend. Because this right here, this little area, I'm gonna make it orange, right? Boom. We see, okay, this little area right here, little sneak peek into tomorrow. This little area right here is where we just came back to retest. But in our reality, it still stands. Once we can get above this high right here, we're good. So let's delete some stuff off the chart. Let's delete the noise box. No, we're not gonna do that. Let's delete the last leg. This is the leg we're looking for now, right? Now you might be able to have this level here and just keep bringing it up, because even though the candle did not close, you're not entering. This is teaching you how to really chase the market. Oh my God, we're trying to learn how candles go. You don't even need these fucking lines, bro. For real. So now we see that's the high, right? And now it's the same thing. We're looking to break above that same high, and boom, we already retested it. So now this is the next high. See if I can get y'all a better view. Yeah, this looks better, right? And we can even add an alert right here, so we know we hit what our TP would have been. Boom, we already up, like not much, like 0.3, like 30% basically. And look, we still got space, right? We still got space. There's no panic, right? It doesn't have to be perfect. So boom, we know it can come all the way down here. But the whole thing is, that's cool, that's momentum. But if it come all the way down here, that's more the trade being wrong. And if it break under here, well, that's us on the wrong side of the trend. And boom, learning candles, looking at candles, understand how candles interact with levels, right? This right here is our next high, 1 minute high. Boom. This video, 11 minutes, 10 minutes. I think I'm gonna keep rolling. This shit kind of fun. I'm gonna roll until we hit TP. I'm gonna roll until we hit TP. Y'all pretty much know how to get long position too. That's in the whole video, so I'm not even gonna stress myself for adding that in here. But just pretty much that first, it don't even matter, it don't have to be a specific time. Just come in, whatever minute you on, boom, mark up the high and low of it. Like we marked up the 751 candle. I can delete the noise box because I know we get the point of that. Just want to make the charts clear. Keep the charts clear all the time. Remove all decisions, extra decisions. Right? So now we in that sense of, oh shit, the trade might be wrong. Because the momentum definitely wrong. The momentum was at that first red high. But boom, let's not confuse y'all. The momentum is right here. So if this candle closed in the next 9 seconds under this 1 minute high, which is the very first high, the very first candle. Oh, look at that. Yeah, we in another chance. This is about to pop, pop, pop up. How do I know? I don't. But that's usually what I see. And it's like, even still right now, I still believe that it's going to pop up because that's usually what I see. How this candle just came and retested it, that's crazy. But now it's different because it's 8 o'clock. We diving into a whole another hour cycle. It is what it is. It's a 1 minute print. And even still, we know that we're not really invalidated to get out of this until right here. And look at that candle. Fuck, that's dangerous. I'm happy. Oh my God. But like, bro, y'all don't really know how grateful I am to like let go of the fear of just doing these videos, bro. Like, for real. I'm just, I don't know. Like, I see this type of shit all the time, and I'm so grateful being able to show it now. I don't even care if it's dropped down. It's like, bro, these type of candles, this hammer candle, bro, that's what we enter on. I'm saying this in the very first video. Not even supposed to do y'all like that, but I am. And just go back into some better information. Might be tough. It could be tough. But once you hear the same thing over and over and over and over and over, you're not trying to sound too smart, right? And be better than nobody. You can admit the smartest person is the person who can admit that they're wrong the fastest. Look at this. Bruh, you can't make this shit up. It's been rejected from the same level. Oh, but now we waiting to break above this next high, right? Oh my God. We just hit TP in 1 second for an equal high. Then we come back down. We got a higher low, and now we even got another higher high. So from how we know, we're really in an uptrend right now on the 1 minute chart. And we don't never gotta